Lender's mortgage insurance or LMI is an insurance that protects the lender in the event you, the borrower, does not have a 20% deposit or equity position. In other words, it allows you to buy, build or refinance a property without the need for a large deposit or equity position. There are two major mortgage insurers in Australia. Banks and credit unions tend to use one or both of these insurers. Let's have a look at how this works. Let's assume you wish to buy a property for $500,000 and only have a $30,000 deposit or 6% of the purchase price. In essence, you are looking to borrow over 80% of the property value. The LMI premium here would be at $14,000. However, if you had a 12% deposit or $60,000, the LMI premium would only be around $5,800. If you actually had a 20% deposit, there is no LMI at all. In simple terms, the bigger the deposit, the less the LMI cost. So, how do you avoid LMI? There are three basic ways to avoid LMI. The first is to have a 20% deposit. The second is to use equity in another property. For example, you may have an investment property, or you might be a first home buyer where your parents may wish to assist with a parental guarantee. And the third way to avoid LMI is there may be government incentives where LMI can be waived. The good news is LMI allows you to buy, build or refinance with a smaller deposit. It's also only a once-off cost. In some cases, you can add LMI to the loan, meaning you don't need it in cash. The bad news is, it is an additional cost and it only protects the lender, not you, even though you paid for it. Also, mortgage insurers are not the bank, so they have their own rules around employment, genuine savings and credit history. We've helped many clients with small deposits, and we know how to structure finances so you get a good result.